Good morning and welcome to the WITAN Investment Trust PLC investor presentation. Throughout this recorded meeting, investors are being in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to James Hart, Investment Director. Good morning, sir.
Good morning, and good morning, everyone. Thank you very much for taking the time to listen to the presentation here by WITAN Investment Trust this morning. I'm James Hart. I'm the Investment Director at WITAN Investment Trust. This presentation is going to take a slightly different format to our usual one that you may be used to hearing in previous sessions. So just to recap. WITAN announced its annual results last week for the year to 2023. Alongside those results, the board also made an announcement saying that Andrew Bell, our Chief Executive, plans to retire during 2024, and that they would take that as an opportunity to review the investment management arrangements of WITAN Investment Trust. In the meantime, and that process is ongoing. And is likely to be concluded by the middle or the end of the summer of this year. In the meantime, we will continue to manage the portfolio in line with the way that it has been managed for the last 20 years. I'm sure that you will have some questions on this subject. All I could say, I'll do my best to answer those questions as fully as I can, but please be aware that I can't necessarily go into full details at this stage. With that said, let's take a quick look at a summary of WITAN Investment Trust. WITAN was founded 115 years ago in 1909. We were listed on the London Stock Exchange in 1924, so celebrating 100 years of listing on the stock exchange this year. And it adopted a multi-manager strategy 20 years ago. Our approach is one of global equity investment, and it is through a multi-manager structure. So we appoint external managers. There are currently seven or eight of them that run parts of our portfolio for us, and they're chosen for their own specialist investment styles. And our aim is to blend those managers together to create a diverse equity portfolio focusing on global markets. As such, the company sees itself as a one-stop shop for investors to get exposure to global equities. We're one of the largest and one of the oldest investment trusts listed on the stock exchange. Current assets at the end of 2023 were about 1.8 billion sterling. And we are self-managed, which means that the chief executive and I and the rest of the employees, of which there are 6 in total, are employed by WITAN Investment Trust. So it's a structure which isn't particularly common in the investment trust world anymore. Most investment trusts outsource the management and administration of the company to a third-party manager who's responsible for the day-to-day running of the trust. Like all investment trusts, we have an independent board of directors, and it's their job to oversee the strategy, implement the strategy, and really to represent the best interests of all shareholders. And they delegate the day-to-day function of running the trust to the investment team and to my colleagues. And we identify potential managers and oversee those managers, as well as carrying out all the operational arrangements of the trust. When a manager is appointed to run money on behalf of WITAN, it is the board, together with us in the investment team, that are responsible for selecting those managers. Quite often we're compared with fund of funds. There is a crucial difference between a fund of funds and the way in which the multi-manager structure works, and that is that all of the assets are held within our custody rather than us investing through a fund. And that gives us certain benefits. That we are fully aware of all trading activity that goes through the portfolio. That gives us quite a lot of insight into the way our managers are thinking and responding to events in global equity markets. It also allows us to carry out detailed due diligence on the portfolio, both in terms of analysis of the various style and factor risks that the portfolio might be exposed to, as well as ESG risks as well. So coming on to the way we think about structuring the portfolio, very broadly, we see the portfolio in two different sections. The core portfolio, which is approximately 75% of assets, is allocated to 6 different managers. 5 of them run global equity portfolios, and 1 runs a UK equity portfolio. Primarily, these are invested in developed market equities, large and mid cap, and although each of the global managers can invest in emerging markets, they tend to be more focused on developed market opportunities in developed market equities. Then we have a specialist portfolio, which is actually made up of 4 or 5 different portfolios. And these look to take advantage of higher growth opportunities throughout the investment landscape, or investing in opportunities that give a different kind of return profile from major developed market global equities. So, for example, within the specialist portfolio, we have an emerging market manager. We have a manager that's invested in a climate change strategy, and we have investments typically through other investment companies into growth assets such as private equity, biotechnology, life sciences, and 1 or 2 investments in companies which look to build out renewable energy infrastructure. So that brings us on to, take a look back at 2023. Here you can see 2023 in numbers. Our benchmark rose by 14.7% last year. Our benchmark is a combination of a global equity benchmark, which is the MSCI ACWI index, plus, and that's 85% of our benchmark, plus 15% UK. So it's a blended benchmark that reflects that the portfolio is built to reflect, but not mirror. Our NAV total return was a couple of percentage points behind the benchmark at 12.7%. And because the discount to net asset value widened throughout 2023, alongside many of our peers as well, whose discounts also widened, the share price total return was 10%. The chart on this page here shows the progression of the absolute and relative net asset value total return versus the benchmark over 2023. So you can see the dark blue line is the absolute return, starting at 100, ending at 114.7. Fairly, obviously there were 1 or 2 little setbacks during the year, but gradual upward tick in net asset value per share. The green line shows our relative performance versus the benchmark. So the first 6 months of the year, well, the first 3 months of the year were very strong in terms of relative performance. We were about 300 basis points ahead of the benchmark. And as we went into the second half, actually Q3, our relative performance took a dip, and we ended up at the end of Q3 about 300 basis points behind the benchmark. The recovery in markets in Q4 and our own relative performance led us to close that gap a little, but obviously not enough to make up the shortfall throughout the year, ending a couple of 100 basis points behind the benchmark. Now we look to deliver capital growth and a growth in income over the long run. So the yield that our shares pay is a byproduct of our investment strategy, but it is an important byproduct of our investment strategy. And the yield currently on our shares is about 2.5%. The gearing, which we have both fixed rate debt and flexible bank debt, and I'll go into the structure of this later on, ranged between 13 and 16%, ended the year at 14%, and it's currently a little less than that at about just over 12%. The discount to net asset value, as I said, widened throughout the year, started the year at 5.4%, ended at 7.8%. And as I go on to the next slide, which shows you the short period from the end of 2023 to date, you can see that that discount, if you look at the top right hand side here, has gone from 7.8% to 9.9%. So it continues to widen, although we are buying back shares regularly and with the aim of reducing that discount volatility, as well as providing an uplift to NAV for the shareholders who remain invested. 2024 to date has continued to be a positive period for markets. I mean, really, 2023 was dominated by a small number of, sometimes known as the Magnificent Seven, a small number of very high growth, high market cap, large companies based in the US. And what we've seen this year is that although one or two of the stocks that are very much focused on AI have continued to drive the market, that performance has broadened out somewhat, and we've seen that it's not just companies that are invested in that small cohort of large tech names that have driven performance, but also some more industrials and companies such as those involved in the aerospace industry or materials have also contributed to returns. So the market appears, as we stand today, as we get closer to the potential for a peak in interest rates and for central banks to start cutting interest rates, it appears that the market is starting to broaden somewhat. And that should be beneficial for a diversified global equity portfolio rather than one which is very focused on those very obvious winners of the last year or two. We can see here that these numbers were done at the end of a few weeks ago. So it says here gearing was 13%, but actually right now it's a little bit less than that. Let's have a look at the portfolio as it stands, or as it stood at the end of December. It's not materially different from this now, so this is a very good guide as to where we are currently positioned. And these numbers are updated in our fact sheet, which is sent out to those on our mailing list, email list, and obviously is available on our website as well. So there you can see the makeup of the core and specialist portfolios in terms of the managers that are responsible for the stock selection within those portfolios. We have, as I say, 5 global managers and 1 UK manager, and they range in style from Jennison at the top of the list there, which is a East Coast US-based manager focusing on very high growth companies, or as they put it, companies with positively inflecting growth rates. So they're looking for the likes of Nvidia or Amazon or LVMH or Ferrari. So very sort of high quality, high growth businesses with high margins and very high quality earnings. The next on the list in terms of style is probably WCM. They are also based in the US, a West Coast manager based in Los Angeles or near Los Angeles. They also look for high quality growth companies, but they have probably they have more of a focus on what they call an expanding moat. So strong barriers to competition, but one where those barriers to competition are growing over time rather than just being stationary. So that leads them to high quality companies, and that they have a very strong focus on corporate culture as well. So the idea being that if a company is well managed, it tends to retain its staff and build on its quality over time. The other 3 names in the global portfolio are all UK based. Lansdowne runs a very adaptable strategy. So at times they can be invested in companies similar to those owned by Jennison and WCM. But at the moment, they see a lot more opportunity in the sort of capital intensive value end of the market, and in particular companies based in Europe and the UK, and somewhat a little down the market cap scale as well. So they give us quite a lot of exposure to mid cap companies, but they also don't ignore opportunities based in the growth space and in the US. So, for example, they'll also own 1 or 2 of the semiconductor manufacturers, or indeed Amazon for that matter. So quite an adaptable portfolio. Sure, Lindsell needs no introduction. They give us exposure to quality consumer staples, consumer discretionaries, and branded consumer companies, as well as financials, but not banks. So these are things like FICO in the US and Hargreaves Lansdown here in the UK. And then Veritas is the last global manager that I'll talk about. And that is they look to buy quality companies at a fair price. So they complement the other managers in the lineup. Looking at the specialist portfolio, I mentioned that the emerging markets manager there, GQG, they're a very adaptable emerging market manager who are quite happy not to own companies in any particular country if they feel that the risks for that country are too great. They look for quality companies, again with an eye on valuation. The climate change strategy run by GMO is unique in our view. It hasn't been immune from the setback that investing in this sort of area has suffered over the last year or two as interest rates have increased. But they look to invest in companies that are set to benefit financially from efforts to mitigate or adapt to climate change. So it might be wind or solar power, but also it can be mined metals used in building out renewable energy grids or batteries. They'll also invest in agricultural businesses to help meet the challenges posed by lower crop yields as the climate changes. And you'll see here we've got direct holdings and unquoted funds. I'll go into more details on those in a second. So when you put all that together, the portfolio looks like this in terms of its spread across the world markets on various factors. I'll focus on three of the charts. The top left one is our regional exposure. You can see that the manager stock selection has driven us to have a exposure of approximately 40% to the US versus a benchmark exposure of just over 50%. So underweight the US at the moment, with a corresponding overweight to Europe. The UK roughly in line with our benchmark, and then as you can see, a minority of the portfolio invested in Asia, Japan, very little in China, and other markets there tend to be Latin America. Pause a second. In terms of our exposure to sectors, the key tilt, if you like, within the portfolio is an overweight to industrials and an underweight to IT. Just a note of caution there. It looks like we're underweight IT to the tune of about 5%. But when we own, for example, very little exposure to Apple, which is one of the largest companies, obviously, that drives quite a lot of that positioning, of that relative positioning. Looking at all the other sectors across the world, we're well represented in virtually all of them except for real estate and utilities, and not materially different from the benchmark either. And then on the bottom left, you can see the way in which the portfolio is weighted towards the different investment styles and sizes. So pretty equally balanced between value and growth, obviously with a predominance of large cap, but also some quite material exposure to mid and indeed small cap. And that represents an overweight versus the benchmark in mid and small cap. And on the bottom right, you can see this is a chart. This is called a style tilt chart, which gives us an indication of which types of equity factors we're exposed to and not exposed to. And you can see that the largest style tilt is a negative size, which indicates that we're underweight the very largest mega cap companies and overweight small and mid cap. Now, I mentioned that we had our direct holdings portfolio, and this gives you a bit more detail on that because it's quite unique to the way in which WITAN allocates to global equities. We've got approximately 11% but it can vary. Typically, it's between 10 and 15% invested in investment companies and other funds. So that is split roughly 50% into private assets, private equity, which we are invested through three key listed private equity funds: Apax Global Alpha, Princess Private Equity, and HarbourVest. You can see here that we've added a column that says discount. We believe that these funds are materially underpriced. Private equity is somewhat out of favor at the moment, and was one of the headwinds for our performance, frankly, last year. The discounts on this portfolio of fund holdings widening, whereas the net asset value of the funds that we own was not materially down. So in fact, it was pretty much unchanged. So the performance delivered by this portfolio was affected by the discounts widening rather than by poor asset performance. So we continue to hold these private equity vehicles. We think they're of extremely good value, and that value should be delivered to shareholders over the long run. The next biggest slice of this direct holdings pie is directed towards infrastructure, sort of what we would broadly term as infrastructure. It's two holdings. One holding is the VH Global Sustainable Energy Opportunities Fund. Unlike most of the renewable energy funds listed on the London Stock Exchange, which are effectively buying existing assets, which deliver a yield to investors because of the power that they generate, that they're then able to return that revenue to investors. This is more to do with building out and then running renewable energy or sustainable energy operations. So, for example, there's a hydropower plant in Brazil. They own a fuel business on the US-Mexican border, which takes high sulfur fuel from Mexico, cleans it up in the US, and then sends it back to Mexico again. So it's much more of a kind of total return vehicle. We're looking for capital growth and income from this. And the other investment we have, which used to be a much bigger holding for us, but we've reduced over time, is BlackRock World Mining Investment Trust. We've owned it for the best part of a decade. It's been a fabulous long-term investment for us. We have trimmed that holding quite materially over the last couple of years, and thankfully that appears to be quite well timed, because the share price has been quite weak over the last 12 months. It's only a 0.5% position for us now, but it's really been weak because demand for mined materials has been dramatically impacted by a lack of demand from China, as China failed to reopen from COVID, and then obviously suffered quite a serious shock to their economic system due to the real estate market. The only other area I want to highlight is life sciences. We have a couple of investments in the life sciences sector. This was struck at the end of 2023 when we did own Biotech Growth Trust. We no longer own Biotech Growth Trust. We took the opportunity to sell that after a material improvement in performance. It was up about 30% from its lows towards the end of last year. It was a small holding for us, and frankly, we'd stopped buying it relatively soon after starting to buy it, because liquidity was very low. So we were concerned that if we had built a material position in this company, we wouldn't then be able to sell it when we wanted to. So we then took the opportunity instead to buy the S&P equal weighted biotech ETF, which gave us very similar return profile to the Biotech Growth Trust, but much more liquid in terms of its structure. Syncona is an interesting company. We've owned it for a long time. A bit like BlackRock World Mining, we sold a material part of our position a couple of years ago at a price significantly higher than it's trading at today. This is a company that identifies and identifies novel drug technologies, and then builds companies around them with the aim to own them through to a point in which they can launch these drugs and they become profitable. It's got a huge cash position as part of its balance sheet, So the discount on which is trading there, it says 30%. Actually, the discount to the biotech assets is more than double that if you think about if you valued the cash on the balance sheet at NAV. So that's looking through. You then find this as our top 20 holdings. We release our full portfolio every month, and that can be found on the website. There are about 250 holdings in total in the WITAN portfolio, and the multi-manager structure naturally leads us to have a diversified portfolio with few companies counting for more than 2% of NAV. And you can see there, except for the holdings that we have in funds via the direct holdings portfolio, which are the top 3 on the list, obviously, and then there are 1 or 2 others further down. The top holding is Amazon at number 4, followed by Diageo, Unilever, Microsoft, and Relax. And then we have some more value opportunities as well, things like NatWest Bank, that sit there in at number 16 on the list. One thing I hadn't mentioned, but I will just point out here, is we started a position in the FTSE 250 ETF not that long ago. Our managers typically have given us quite a lot of exposure to the UK market, but we had reduced that a little bit. We wanted to retain exposure to the UK, particularly to the mid cap, because we felt that it is a materially undervalued part of the global equity universe. But the benefit as well of owning the FTSE 250 ETF is that about 35% of the FTSE 250 is made up of investment companies, which I'm sure you'll know are trading on average at a significant discount to asset value. So by buying the FTSE 250 ETF, it gives us exposure not only to some of the best mid-cap companies in the UK, but also exposure to a basket of investment companies that are trading on a significant discount to asset value. I'm aware that I'm going to talk for about another 5 minutes, so I'll kind of whiz through some of the more corporate level information here. As I mentioned at the beginning, we look to pay a progressive dividend. We've increased the dividend every year for the last 49 years, and the nature of our portfolio, as well as the structure of an investment trust, allows us to increase that dividend year after year. We use revenue reserves where revenue falls short, and that has been the case since COVID, when there was a material drop in revenue received by investment portfolios. But the structure of the investment trust allows us to use that revenue reserve to maintain a growing dividend. I also mentioned earlier that we use gearing. We believe this is a fabulously attractive gearing structure that WITAN has in place. You can see here that we have 4 different, they're called private placement notes, but they behave just like bonds. They were issued between 2015 and 2019 and have a maturity from 2035 to 2054, so very long dated. The aggregate interest that we pay on those 4 bonds that total about 155 million sterling is 3%. So we're borrowing for the best part of up to 30 years at 3%, which is 1.5% cheaper than the UK government can borrow at, or perhaps 1.25% now, because gilt yields have come down a little bit. So we think that's a fabulously attractive long-term gearing structure, and it means that provided we can find investment opportunities that deliver us a return of 3% or more annualized, that's very positive for our shareholders. And you can see there on the left-hand side the contributions from borrowings over the last decade. Clearly, in times where the market is weak, the returns are, the contribution is negative, but overall the contribution has been very positive over the long run. And the cost, of course, of that debt has come down gradually over time, although clearly there's been an uptick in the cost last year because we also have some short-term bank borrowings to the tune of about 100 million, where we pay the market rate. So that's at the moment 5.25% or more. But we obviously, as rates come down, we would expect the interest that we pay on bank borrowings to reduce. Costs of running WITAN, our ongoing charges has declined over time, and currently sits at about 76 basis points. We show it including and excluding performance fees here. Frankly, there's only one manager that is due a performance fee if they outperform their benchmark, and it's a very, very small allocation for us, 3% of our overall portfolio. So performance fees should not impact ongoing charges, because the pre and post performance fee number should be very similar. Just very briefly touching on our responsible investment policy, we have committed that we will have a portfolio that is populated by sustainable businesses by 2030. To do this, we have to define what a sustainable business is, and really, I'll come on to the next slide to show you that. But it's driven by two key factors, and this is for us is a financial decision. There are two key drivers of responsible investment. It's climate change and it's a change in social expectations. And if companies don't operate in line with those two expectations, then over the long run they'll find their revenues under pressure. So what's a sustainable business? Well, we divided the world up into four different major headings: prosperity, people, planet, and partnership. And this is on the bottom left of the slide here. And then subdivided it into 10 different characteristics, which we think, when applied to every single company in the portfolio, we can judge whether they meet our definition of sustainability. We're not expecting every company in the portfolio to achieve that today, but what we do want is for those companies to make progress along a journey to being more sustainable businesses over time. And I'm very happy to answer questions on this slide later if people want further detail. Just pausing on performance. We look to deliver long-term returns for shareholders. We want to, as our sort of mission statement, if you like, says, deliver significant growth in investors' wealth over time. Clearly, on an absolute basis, this is something that's been achieved. We've had a couple of periods of performance, notably in the start of COVID, where we were materially ahead of the market before COVID, and had a period where, over a few weeks, where we gave up that long-term outperformance. Recovered quite sharply through 2021 and 22, and then again with the onset of the Russian invasion of Ukraine, coupled with steeply rising interest rates, that was another difficult period for our collective managers. But really, since that low point in 2022, we've largely kept pace with the market. So not a straight line by any means, and obviously we'd prefer our returns to be better in relative terms, but in absolute terms, not a unsatisfactory result. You can see here the discount to NAV I mentioned earlier. Back in 2014 and 15, we traded at a premium to asset value. We believe that WITAN is capable of trading back towards asset value, or indeed above it. So at the meantime, with discounts wide, both our own discount, but also the discount of our peer group, which is shown here by the pink line, we will be buying shares back to take advantage of that wider discount. And I think with that, I will stop and hand back. I've got an outlook slide here, which I'm sure people will want to talk about, or I'll be happy to talk about if people want me to. But I'll hand back at this stage and open it up to questions.
Fantastic. James, thank you very much indeed for the presentation. As James said, ladies and gentlemen, do please continue to submit your questions. Just click on that Q&A tab, scroll to the bottom, type your question and press send. But I'll just take a few moments to review those questions already submitted today. I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James, as you can see, we've had a number of questions throughout today's presentation. So if I may just ask you to click on that Q&A tab and start at the top, just read out the question question, and I'll pick up from you at the end. Thank you.
Okay, I'm going to start with question number one, controversially. Seeing the AI boom, why does SMCI, Nvidia, and Micron not have a higher percentage of the investments for WITAN? Well, I think there are a couple of answers to this question. Firstly, the multi-manager structure, as I pointed out, naturally leads us to have a diverse portfolio of 200 plus companies. Rarely does a single company have a feature in our portfolio that's more than 2 or perhaps 3%. Companies like Nvidia and indeed Apple and Microsoft are huge positions in our benchmark these days because they are just enormous companies. I think Nvidia, for example, is about 2.5% of our benchmark. We've got about it's about 1.4% position in Nvidia at the moment. And that's actually held by 3 of our 8 managers. So the first answer to the question is the multi-manager structure leads us to have a more diverse portfolio than you might expect if you were to invest via a single manager who has a very strong view on a small number of companies. The second answer to that question is, well, it's not just these 3 companies that kind of represent the AI boom. We did some work on this, and it's at roughly 10% of WITAN's portfolio is invested in companies that sit within a sort of well-recognized AI benchmark. So you could say loosely that there are about 10% of WITAN's portfolio is exposed to AI-related stocks. So that's that one. How do I get an update on my WITAN Investment Trust investment? Well, I guess I think the answer you're looking for here is how do you get news flow on WITAN? That's very easy. You can go to WITAN's website, and which is witan.com, and if you click on Get in Touch, there's an option to stay in touch, and you can complete the information request, and we can add you to our list for news coming out on the trust. I believe that you have a large issue position in Princess Private Equity. Could you comment on recent developments post dividend cut and their new strategy? I can't go into huge detail because a lot of the conversations that we've had with Princess Private Equity have been sort of behind the scenes with the manager and with the board. You're right to say that, I mean, we were very disappointed by the dividend cut that frankly could have been and should have been avoided, or the board should have been more on top of the pressure on the balance sheet that was created effectively by a currency hedge. We are very supportive of the new chairman, Peter McCullough. He has set out a new strategy, and indeed a strategy to return free cash flow to shareholders. We actually believe this is a strategy that should be adopted by virtually all listed private equity vehicles, and so we would be supportive of other listed private equity vehicles adopting a similar approach. So I think it's no surprise that in having been a poor performer in 2022 on the back of that dividend cut, Princess Private Equity is one of the best performers in 2023 and currently sits at a 20-something discount to asset value, which is a premium rating versus many others in the sector, and we think it's justified from the action that the board has taken. Next question was, gearing contributed positively. What is the approach to managing gearing, especially in light of interest rate fluctuations and market volatility? We are flexible in our deployment of gearing, but we don't try and market time. Really, the amount of gearing that we have in place is dictated by the investment opportunities that we see, combined with the sort of general valuation levels of the market and our portfolio. So at times where we consider the market to be fairly or cheaply valued, or indeed if our portfolio is cheaply valued, then we will probably have higher gearing than lower gearing. Clearly, clearly market volatility can be a risk when you're running gearing. So we do limit the amount of gearing that we have in place. We stop investing with gearing at 15%. So in other words, if you go into a market setback, you still have the flexibility to decide whether to cut gearing in that environment, or whether you leave the gearing in place if your assumption is that the setback is short term and unwarranted. So I think, yeah, it's long term, but it is adjusted to take into account our kind of medium term outlook, rather than necessarily to try and duck and dive with every short term move in the market, because frankly, markets tend to be on a positive trajectory over the long term, and to try to be too clever with the use of gearing means that you will quite often miss out on periods of positive performance if you try and be too clever. What do you think the trust will be able to outperform passive fund eventually? Good question. Yeah, it's been a tough environment to outperform passive. When you have active managers and a collection of active managers, and such a small number of very large companies delivering substantial amounts of return for the benchmark, and therefore obviously for passive funds, it has been a difficult environment to outperform. I think that we are going into an environment now where interest rates have clearly peaked. I don't think that they will come down rapidly, but we are likely to see a few interest rate cuts this year. And what we have noticed in the last few months is that as I mentioned earlier, the breadth of the equity market is just starting to, a broader selection of companies is starting to outperform the benchmark, which lends itself to an actively managed portfolio being able to outperform. So I think fingers crossed. I certainly think there's huge benefit to active management, and hopefully that we can deliver with our active management, deliver outperformance over the long run again, as we did do for a very long period prior to 2022. Have you considered offering to buy back shares from current owners at a closer price to NAV, say a percentage of current ownership? I'm not. I think this is probably alluding to a tender offer, which is not something that we have considered or we believe is in the best interests of our shareholders, because while we do buy back shares, and obviously we want the share price to be closer to net asset value, a sort of one-off buyback at a closer discount to net asset value has a smaller impact for remaining shareholders than buying shares back at a wider discount. And there's absolutely no evidence whatsoever that tendering shares or doing a tender at close to asset value has a material long-term impact on the discount. So while we buy back shares irrespective of where our peer group is trading, we are also mindful of the kind of the peer group's discount as well, and we can't levitate our own discount in isolation. So no, I think the ongoing buybacks at the market price are the right tool to deliver the best return for shareholders. Are you worried about the trust income not covering the dividend? No, it is currently uncovered, and has been uncovered since 2020, although each year post-COVID, that gap between the dividend we pay and the revenue we receive has narrowed. The modelling that we've done suggests that the dividend, assuming it grows at the rate that it's growing at the moment, and the income, again, assuming it grows at the rate at which is forecast, means that the dividend that we pay will be covered before we use up revenue reserves. So we're not concerned that the revenue won't be covered. What do you think will be the catalyst for the discount on private equity funds reducing? Gosh, I think there are all sorts of answers to this question. Probably more answers for this than we've got time for today. But I'll give you a few headline things. I think interest rates clearly are one thing. So declining interest rates will be positive. I think another issue is there is some skepticism about the net asset values at which these portfolios are valued, unjustifiably in my view. I think it's important to differentiate between good quality buyout private equity and the kind of crazy valuations that were attributed to some venture cap businesses, or businesses backed by venture cap in 2021 particularly, where there was this just euphoria around potential new technologies changing hands at huge valuations. So I think really so the answer to that is the sale by private equity of assets at or above holding values will lend support to those net asset values, or belief in those net asset values. So it'll take time because the private equity market has been certainly not closed, but the rate of realizations last year was slower than it had been for previous years. So I think some decent sales at or above NAV would be very helpful. And then, without going into hugely complex issues, there is a current issue around about the way in which investment companies are required to disclose what are called synthetic costs. So it's cost disclosure where frankly you're effectively you're disclosing twice the costs of an investment. So when a wealth manager or a private client stockbroker owns a share in a listed private equity vehicle, it should be the share price that the investor benefits from, or not the net asset value per se. And so there is a requirement to kind of double count the costs of owning that vehicle, and that's making people shy away from sectors such as private equity, which is seen as being very expensive. But obviously, what's the most important thing is performance after costs, and year in year out, private equity has delivered superior performance, which is one of the reasons why we're invested in it. Our family office has held WITAN for almost 40 years. We have been concerned in recent years about the trust being behind the curve in terms of absolute weighting in the US, and also the composition of the US portfolio. Why haven't the managers meaningfully increased exposure to the US? The first answer to that question is that we have a bespoke benchmark that has evolved over time, and our weighting in the UK and the benchmark has declined materially over time. We still have 15% weight in our benchmark, which is obviously naturally leads us to have less US than you would get from a passive index tracker or a fund that is exclusively trying to beat a global benchmark. And of course, the US is now 60-something% of a global benchmark. So that's one answer. The last time we changed managers was in 2020, and the two managers that we appointed were Jennison and WCM, and we appointed them specifically to address areas of the portfolio that weren't being addressed by the current lineup of managers, primarily higher growth companies and, as you say, US domiciled companies. And that has increased our exposure to the US, and as I say, we're kind of 40% in the US versus 50% for our benchmark. We're very happy with the composition of the US portfolio. We've got a lot of the we believe we've got a lot of very high quality assets in there. But I think also there's a byproduct of having an active portfolio is, even if you choose managers who naturally are likely to invest in higher growth businesses, those businesses aren't always domiciled in the US. And so, for example, even those two managers who are running a global equity portfolio have got meaningful exposure in Europe, for example. So as I mentioned Ferrari earlier, they own companies like LVMH, they own one or two payment, the Adyen, the Dutch payment company, ASML. So I'm less concerned about the domicile of a company than the returns that those companies can deliver. And I think you're absolutely right. The US has been the home to a lot of those higher growth businesses, but not exclusively so. What's the basis for believing that WITAN will trade back at NAV? Isn't this largely a function of demand for WITAN shares and by extension the performance of WITAN versus benchmark and against peers such as Reliance Trust? Absolutely right. I think performance drives returns, and well, I think there are three things that drive the discount. It's doing something that's relevant, it's executing that well, and communicating it clearly. I believe we're doing something relevant. We clearly have had a couple of periods in the last few years where the execution has been less good than we would have liked, and we work hard on communication. So really, it's down to performance, and so day in day out we strive to produce better returns. And although we had a couple of periods in the last few years where returns have been below where we'd like, over the long run, we're hopeful that the way in which WITAN is managed will put us back on a winning track, and therefore that'll help to drive demand, which will then help to drive the discount narrower. I'm not sure I understand the next question. Is cyber intrusion a particular difficulty for WITAN? I'm going to skip that one because I'm not entirely sure what the question is asking. But if you want to kind of rephrase it, I'm happy to look at that one. What can you do to improve performance, given it is possible to outperform the benchmark in recent years? I kind of answered that one. I think it's the one thing I would say about outperforming the benchmark. One of the reasons why we've underperformed is our choice to invest in some more specialist assets, which we believe have got a kind of long-term prospect for outperformance. Indeed, the climate change strategy that we own through GMO has had a fabulous period of outperformance for a long time. That's really suffered in the last 12 to 18 months. We think there's a very long-term tailwind for that kind of investment strategy. So a turnaround in the fortunes of those kinds of strategies will be very helpful. And our own direct holdings portfolio, which, as I said, in NAV terms has been fine, but in share price terms has suffered because of widening discounts. A turnaround in fortune in those investments would also be very helpful to relative performance. And I think both of those have been impacted by higher interest rates. So I think there's a fighting chance that as interest rates start to decline, or indeed the market believes that we're at the start of a falling interest rate environment, there's a good chance that those strategies that have been a headwind to performance turn around to be a tailwind to performance. When you look at our core managers, last year they performed broadly, actually slightly ahead of the benchmark. So we think we've got the right managers in place. It's just one or two of the more specialist strategies have been a bit of a headwind, sorry, in recent months. Can you update on Andrew Ross's statement on reviewing the structure for the management of WITAN's assets? Yes, absolutely. I mean, I pointed to this at the start of the presentation. I can't go into much more detail than was put out in the announcement, but the announcement itself said that the board would take the opportunity of the retirement of Andrew Bell, the chief executive, to review the management arrangements for WITAN's portfolio, and that is a process that is ongoing and is unlikely to be completed much before the middle or the end of the summer. Shareholders will be kept informed of the outcome of that process. I would say that WITAN is a global equity investment company. The assumption is that it will remain so. But really, there are likely to be a number of proposals that the board receives, and the choice that they make will be guided by what they believe is in the best interest of shareholders. But I think that the default outcome, or the most likely outcome, is that WITAN continues to offer a diverse global equity portfolio to shareholders. The form in which that is delivered is open to all sorts of decisions. But we will keep shareholders obviously informed as the process is completed, hopefully, as I say, by the middle or the end of the summer.
Fantastic. Thank you very much indeed. And you've taken every single question that's come through, so that's much appreciated, I'm sure, by everyone.
Well, I tried to. There was one that I skipped on, which I wasn't quite sure of, the cyber intrusion issue, but not something that WITAN has faced, if that was the kind of the thrust of the question.
Perfect. That's fantastic, and thank you, as I say, for covering over every single question that we've had come through. And of course, any further questions that do come through, James will have the ability to review those. Before redirecting investors to provide their feedback, which I know is particularly important to you and the team, can I just ask you just for a few closing comments, please, James?
Yeah, I think we're sitting here on the slide here showing the outlook. I think that it's an important slide for us. As one or two of the questions stated, performance has been a little bit checkered on a couple of periods in the last few years, which has impacted WITAN's long-term outperformance of its benchmark. We want to get back to a place in which we were delivering really superior outperformance of the benchmark over the long term. And the slide here, I think, speaks to that, and that is that we are at a crossroads in the global economic environment, and we think that the crossroads that we're at and the path that we're heading down will be more beneficial to our multi-manager structure as it is in place at the moment, to deliver returns for shareholders. And irrespective of what it is that the board decides to do, that's the one thing that they have right at the front of their minds is how WITAN can take its 100-year history or 115-year history and continue to evolve as it has done over the last 100 years, to continue to offer something that's relevant to shareholders, that's well executed, and that we continue to communicate with a broad investor base, and hopefully therefore deliver superior NAV returns and also get that discount closer to NAV.
Fantastic. James, thanks indeed for updating investors today. Could I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order that James and the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of James and WITAN Investment Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.